China may have just delivered a quiet but devastating blow to Russia's already fragile economy. It's the kind of move that doesn't make headlines at first glance, but could reshape Moscow's financial future. For years, Beijing had been quietly supporting Russia through a shadowy system of hidden subsidies, a financial cushion disguised as trade. These weren't official aid programs or public deals. Instead, they worked behind closed doors as quiet rebates and discounts for Chinese state-owned companies that imported Russian metals like copper and nickel. Those deals let Chinese firms buy Russian metals cheaply, resell them at market prices, and pocket the difference. It was a mutually beneficial arrangement. China got affordable raw materials, and Russia got a crucial buyer at a time when most of the world wanted nothing to do with its exports. That system became a lifeline after Western sanctions isolated Russia from global markets following the invasion of Ukraine. When the European Union and the United States shut their doors, Moscow suddenly lost access to major trading hubs like the London Metal Exchange and the Chicago Mercantile Exchange. Practically overnight, China became Russia's last reliable customer. But it wasn't just buying metals. It was quietly keeping Russia's economy breathing. Those secret incentives kept Russian miners working, factories open, and the ruble from sinking even faster. It was an unspoken deal that helped both sides. Russia needed cash flow, and China wanted cheap materials to feed its manufacturing industry, which is currently battling slower growth and rising costs at home. That balance shattered in September, when Beijing abruptly ended those hidden subsidies. Without any official announcement, the financial safety net that had propped up one of Russia's last major export industries vanished. The timing caught many analysts off guard, because it came just as Russia's war expenses are skyrocketing and energy revenues are shrinking due to oil price caps and reduced global demand. The impact was immediate. Chinese importers, now without financial perks, began scaling back orders. Russian copper sales to China, which had risen by 66% earlier this year, and nickel exports, which had more than doubled, are already beginning to stall. For years, this system had kept Russian aluminum trading more than 20% below global market prices, allowing Moscow to stay competitive despite sanctions. Now, with the subsidies gone, the cost advantage has evaporated. Beijing has little incentive to continue subsidizing Russia's war-drained economy when it's facing its own financial slowdown and property crisis. Recent reports also suggest China is redirecting its trade priorities toward domestic production stability and new partnerships in Southeast Asia, where it can secure similar resources without geopolitical baggage. Cutting Russia's subsidies could also be Beijing's way of reminding Moscow who holds the real leverage in their so-called no-limits partnership. By removing these quiet financial lifelines, China shows that its loyalty has limits and that it won't bleed economically for Russia's war. So here's something to think about. Why would China choose this moment to pull support? Is it a strategic play to strengthen its global position? A cost-saving move for its slowing economy? Or perhaps a subtle warning to Moscow? And if Russia's last major buyer is stepping back, what does that mean for its already collapsing currency and shrinking export base? Looking at the numbers, it's obvious the Chinese subsidy system worked better than most people realized. It was a smooth win-win setup. Russia kept its factories running and export figures strong, while China got access to cheap raw materials to fuel its manufacturing engine. For years, both sides played their parts perfectly. But that quiet partnership is now unraveling. Beijing has started stepping back, and while no official reason has been given, the signals are clear. China doesn't want to tie its economy too tightly to a country that's been locked out of global markets and stuck under heavy sanctions. It has its own domestic troubles to worry about: a property market meltdown, slowing growth, and a youth unemployment crisis. Supporting Moscow's struggling economy is simply no longer worth the risk. By ending these subsidies, China isn't just cutting costs. It's insulating its industries from price swings, trade instability, and reputational damage that come with doing business with a sanctioned state. In the process, it's quietly letting Russia's economy fend for itself. But there's another, less talked about reason behind China's pullback. The Kremlin's finances are stretched thin. Corruption is rampant, and foreign investors have all but vanished. China, always cautious about global perception, doesn't want to be dragged down with a partner seen as unpredictable and volatile. Since the subsidies ended, the effects have been immediate. Without the hidden discounts, Russian metals are suddenly far less appealing on the world stage. Chinese importers, who once relied heavily on those deals, have started turning elsewhere, to suppliers in Southeast Asia, Africa, and Latin America. These regions not only offer cheaper labor and new reserves of copper and nickel, but also come without the baggage of war or sanctions. And in international trade, once buyers shift their supply chains, it's almost impossible to win them back. That's exactly what's happening now. Russian copper and nickel that once moved quickly are piling up in warehouses, unsold and undervalued. Exporters are struggling to close deals, profit margins are evaporating, and with no competitive pricing edge, Russia is rapidly losing its foothold in the global market. For Moscow, this is more than just a trade setback. It's a direct hit to the foundation of its already fragile survival strategy. The government's war expenses are climbing month after month, draining funds from every other sector. Social programs have been slashed, regional subsidies are shrinking, and pensions remain frozen. Inflation has surged, pushing real wages down more than 8% this year alone, and ordinary Russians are feeling the strain as prices rise and paychecks lose value. With the metals industry crumbling, that financial pressure is set to intensify. Russia's federal budget depends heavily on export taxes and energy revenues. They're the arteries that keep everything from military operations to healthcare running. Metals like copper, nickel, and aluminum generated over $60 billion last year, plugging budget gaps left by falling gas prices and reduced oil exports. That money kept factories operating, workers paid, and the ruble from free-falling. Now, with that stream drying up, the Kremlin faces a fiscal storm it may not be able to weather. Was China's decision purely economic, or was it a subtle political statement, a warning that Moscow's instability has become too risky to support? And with metals revenue collapsing, how long can Russia keep financing both a war abroad and an economy unraveling at home? Now that China has started scaling back its quiet financial support, one of Russia's most important income streams is falling apart. The discounts are gone, demand is shrinking, and prices are sliding fast. Export volumes have already dipped sharply, and industry analysts predict that Russia's metals revenue could plunge by as much as 20 to 30% before the end of the year. That's not just a dent. It's a crater in the country's economic foundation. It means less money flowing into defense spending, fewer resources for struggling regions, and even more strain on the already weakened ruble. This isn't just another financial setback. It's a direct hit to the system that's kept Russia's wartime economy on life support. The Kremlin now faces an impossible choice: either cut deeper into social programs and public services, or print more money to stay afloat, a move that would likely send inflation soaring even higher. And all this comes at the worst possible time, as Moscow battles the combined pressures of war costs, trade restrictions, and an increasingly isolated market. What makes this blow especially painful is that Russia doesn't have the leverage to push back. It can't threaten penalties or renegotiate terms with Beijing. China holds all the cards. And, predictably, the fallout isn't mutual. Beijing loses nothing from pulling away. Without those subsidies, Chinese companies can now shop freely for metals on the global market, choosing whichever supplier offers the best price and reliability. Ironically, that still includes Russia, but now Beijing can buy at bargain rates with no strings attached. Russia, on the other hand, is backed into a corner. With limited buyers left, it's being forced to offer even steeper discounts just to keep shipments moving. Otherwise, it risks having warehouses stacked with unsold metals that nobody wants. It's a lose-lose situation for Moscow. Either sell cheap or don't sell at all, and in both cases, China walks away as the winner. The ripple effects of this shift are being felt far beyond Russia's borders. Until recently, Moscow was one of the world's biggest suppliers of nickel, copper, and aluminum, the very metals that power everything from skyscrapers to smartphones. With Chinese demand cooling and Russian exports collapsing, that global balance is starting to crack. Market traders in hubs like London and Singapore are already seeing volatility rise. Supplies of high-grade nickel and refined copper are tightening, while Russia floods the market with lower-quality stock at discount prices to keep its cash flow alive. The result is chaos, a strange mix of scarcity and oversupply that makes prices swing wildly from week to week. This unpredictability doesn't just hurt Russia, it's shaking up competition worldwide. Producers in Chile, Indonesia, and Peru are facing erratic price benchmarks as their metals are suddenly compared to Russia's cheaper, lower-grade offerings. It's throwing off contracts, supply forecasts, and long-term planning across the industry. Yet, for some countries, this crisis has opened new doors. Resource-rich exporters in Africa and South America are using the opportunity to renegotiate deals and capture new buyers, especially in China, which is now spreading its purchasing network wider than ever before. This has caused people to wonder if this is the start of a permanent shift in the global metals trade, where Russia fades into the background and emerging economies step up to fill the gap. And as China diversifies its suppliers, could this be the moment it quietly rewrites the balance of power in global resource markets?
If you've made it this far into the video, it means you're enjoying what we do here at Euro Bulletin. Take a second to hit that subscribe button so you don't miss more updates and insights from Europe and its partners. Let's dive in more into the subject.
Behind the scenes, quiet changes are rippling through boardrooms and ministries from Moscow to Beijing. Trade contracts are being rewritten, long-standing terms are shifting, and new economic alliances are starting to form in places few expected. What began as a subtle shift in China's buying habits is now snowballing into a full-blown global reset in how metals and even energy are traded, priced, and prioritized. On paper, China and Russia still call each other strategic partners, repeating the same scripted language about cooperation and shared goals. But beneath that surface, the relationship is changing fast, and not in Moscow's favor. The latest trade data tells the story better than any speech. In August, Chinese exports to Russia fell by more than 16%, while Russian exports to China dropped nearly 18%. For two nations that once boasted about having an unbreakable friendship, those numbers look more like a quiet breakup than a partnership. Just 2 years ago, things looked very different. Trade between the two nations was booming. China was snapping up Russian oil at record levels, and Russian shelves were flooded with Chinese cars, electronics, and machinery after Western brands pulled out. It was the height of what officials in Moscow proudly called their pivot to the east. But that honeymoon didn't last. Once China got what it wanted, cheap fuel, discounted coal, and low-cost metals, its enthusiasm started to fade. Beijing used Russia's desperation to fill its energy reserves, expand its market share, and lock in long-term deals with Gulf nations that could now replace Moscow's role. By the time its tanks and warehouses were full, China no longer needed Russia's bargain bin supplies. And China, famously pragmatic, doesn't buy out of loyalty. Its allegiance has always been strategic, never sentimental. Russia, by contrast, remains trapped in dependence, its economy tethered to Chinese demand that can disappear at any time. But the drop in trade numbers is only the surface of a much deeper shift. What's really changing is China's behavior. Over the past year, Beijing has been quietly cutting exposure to anything that might draw unwanted attention from Washington. The United States, now under Trump's second term, has launched an even tougher wave of sanctions, not only against Russia, but also against any company, anywhere, that helps Moscow sidestep restrictions. Chinese banks, shipping firms, and tech suppliers are all in the crosshairs. The message from Washington couldn't be clearer. Help Russia, and you'll pay for it. For Beijing, already juggling a fragile property market, slowing growth, and record youth unemployment, a direct financial confrontation with the US would be disastrous. So, while it continues to buy Russian oil to keep energy costs low, it's scaling back almost everywhere else. Deals for industrial metals, electronics, and construction equipment are quietly being canceled. Major infrastructure projects that once symbolized unlimited partnership have slowed or frozen altogether. Even Chinese banks are now treading carefully, tightening compliance rules, delaying transfers, and in some cases closing accounts linked to Russian clients who look too risky to touch. Could this be China's way of signaling that it's no longer willing to be Moscow's economic crutch, or simply a smart move to protect itself from U.S. retaliation? And as Beijing pulls back, could this be the moment when Russia finally realizes its pivot to the east was built on borrowed time? Across Moscow, the tone of the relationship with Beijing has noticeably cooled. Inside government offices, officials are scrambling to contain the fallout. The Ministry of Industry and Trade has floated emergency tax breaks and temporary incentives to help struggling exporters stay afloat. But the mood remains uneasy. State media, meanwhile, is doing damage control, assuring viewers that China is simply adjusting to global changes. Yet behind that calm language, nervous meetings are happening in boardrooms across Russia's metal and energy sectors. Top executives have reportedly urged the Kremlin to pressure Beijing for renewed support, but so far there's been no progress. The same quiet desperation is echoing through other industries that depend on Chinese demand. On the other side of the border, Chinese corporations are moving just as quietly, but with far more confidence. Major firms like China Minmetals and Norinco are re-evaluating their contracts with Russian partners and shifting future supply orders to South American producers, particularly in Chile and Peru, where prices are steady and the political risks are minimal. None of this is being publicly announced, but the silence itself says everything. This isn't a diplomatic misunderstanding or a temporary pause in trade. It's a carefully calculated repositioning. China is tightening control over its supply chains, protecting its industries from volatility, and prioritizing economic security over political loyalty. Even in the defense sector, the shift is striking. Only a year ago, Russia and China were discussing joint projects on military technology and aircraft components. Now, many of those initiatives have vanished. Some have been indefinitely paused, others have been quietly abandoned altogether. Beijing understands how fragile its own tech sector has become under Western scrutiny. With Washington and Brussels already treating major Chinese tech firms as potential security threats, any hint that they're supplying Moscow with sensitive components could trigger devastating sanctions. China won't take that risk. Its leadership knows it can't jeopardize its long-term ambitions, becoming a global tech leader and stabilizing its economy, just to prop up a Russian defense industry that's been exposed as inefficient and dependent by the war in Ukraine. There's a certain irony in this moment. For decades, Moscow warned against over-reliance on Western economies and promised that turning eastward would secure its independence. But that pivot has left it more dependent than ever, this time on Beijing's goodwill. And when that goodwill stopped being useful, China simply stepped back. The power dynamic has flipped, with Beijing now holding all the leverage. What looks like a minor policy adjustment, ending subsidies for companies that buy Russian metals like copper and nickel, has in reality reshaped an entire economic relationship. From China's perspective, though, the move makes perfect sense. The average Chinese citizen isn't focused on Russia's war or its consequences. They're worried about their own day-to-day struggles, jobs, housing, and the rising cost of food and utilities. State media rarely criticizes Moscow directly, but it doesn't glorify the war either. Online, young people discuss unemployment and rent far more than foreign conflicts. There's little public appetite to spend national resources helping another country fight a costly war with no clear end. Beijing's leadership sees that sentiment clearly. With growth slowing, youth unemployment at record highs, and the property market unstable, pouring money into Russia's economy could hurt China more than it helps. Cutting the subsidies was, in many ways, a pragmatic decision, a way to protect domestic stability and keep funds focused on homegrown recovery. That doesn't mean the relationship has ended entirely. Trade continues, but the tone has changed. Deals are smaller, payments take longer, and contracts are now written with caution. Every transaction happens on Beijing's terms. For Russia, the message is unmistakable. The era of guaranteed buyers and quiet financial support is over. For Moscow, this shift is nothing short of a disaster. And it's not just the metals sector taking the hit. Nearly every major Russian industry that depends on Chinese demand is now feeling the squeeze. The once booming timber trade, for example, is slowing sharply as China's real estate market cools. With construction projects on hold across major cities, orders for Russian wood have dropped, leaving sawmills, trucking firms, and border towns struggling to stay afloat. Machinery and chemical exports are also stumbling. Russian producers report delayed payments, canceled contracts, and tougher financing terms as Chinese buyers grow cautious and begin sourcing from Southeast Asia and even parts of Europe. Without access to even agriculture, long seen as a safety net against Western sanctions, is beginning to strain. Grain, meat, and cooking oil shipments to China are slowing as buyers diversify their suppliers. Nations like Kazakhstan, Uzbekistan, and several African exporters are filling the gap with cheaper, lower-risk alternatives. Russian producers are now cutting prices just to keep their goods moving, a dangerous sign for an economy already stretched thin. What's unfolding isn't a temporary dip, it's a gradual withdrawal. China hasn't cut ties completely, but it's clearly reducing its exposure, sector by sector. What began quietly with metals has now spread to timber, machinery, chemicals, and food. Piece by piece, Russia is watching its biggest trading partner step back. China's motives aren't emotional, they're strategic. Beijing is focused on stabilizing its own economy, not rescuing someone else's. For years, China's growth relied on heavy spending, subsidies, and massive exports. Now the focus has shifted to sustainable, high-quality growth. Every yuan must serve long-term national goals. Supporting Russia no longer fits that vision. Canceling subsidies and cutting risky deals shields China's industries from global shocks and strengthens its influence in key markets. And that strategy isn't limited to Russia. Across the world, countries that once relied on Moscow are looking elsewhere. India, for instance, has scaled back purchases of Russian commodities amid tighter Western sanctions, showing little interest in filling the gap. As Russia loses customers, it's also losing leverage, and China is quietly taking its place. Beijing is moving fast to occupy the spaces Moscow once dominated. In Central Asia, pipelines, railways, and trade corridors, once under Russian control, are increasingly financed and managed by China. The Korgos Gateway on the Kazakhstan-China border is now a major logistics hub, bustling with Chinese investment. In Uzbekistan, Chinese firms are funding power plants and new industrial zones. In Kyrgyzstan, Beijing-backed rail projects are creating routes that bypass Russian networks entirely. Even Turkmenistan's energy infrastructure is being reoriented toward China, with new gas processing plants reducing dependence on Russian pipelines. Each of these developments chips away at what was once Russia's uncontested sphere of influence. The contrast is striking. As Moscow retreats, Beijing advances. China is expanding not through military pressure, but through money, infrastructure, and patience. Every project, from metals to energy, from trade routes to digital networks, marks another step in a quiet takeover. The balance of power that once tilted toward Russia is now clearly shifting east, and Beijing is in no rush to hide it. In its war-torn state, Russia simply can't keep up with China's scale or strategy. It's like watching someone play checkers against a chess grandmaster on a shaky table. Every move feels one step behind. Globally, the fallout is brutal. Nations that once leaned on Moscow for energy or resources are now hesitating, aware that Russia is barely keeping itself afloat. Metal exports are shrinking, energy deals look increasingly risky, and Moscow can no longer offer stability or capital to its partners. Even its closest allies are growing cautious. After all, if Russia might soon need a bailout, who wants to take their help? The country's shrinking circle of buyers has left it isolated, forced into smaller, less profitable deals that drain what little leverage it has left. China, meanwhile, is seeing the opposite effect. By cutting subsidies at exactly the right moment, Beijing not only reduced its own exposure, but also positioned itself to dominate the same markets Russia once controlled. It didn't need to make a public announcement or show off its military power. The results are visible without a single headline. As Russia loses ground, China gains influence. For the Kremlin, this isn't just an economic setback. It's a political blow that strikes at the image Vladimir Putin has spent 2 decades cultivating. Russia's leadership thrives on projecting control. Every televised meeting, every official speech crafted to say, "We are strong." But when a key partner like China quietly steps away, that image begins to crack. Numbers don't lie, and no amount of state media spin can hide falling revenues. When less money comes in, someone has to pay the price. And that someone is the average Russian citizen. Prices are rising in grocery stores, imported goods are harder to find, and the ruble's decline means that everything from electronics to food costs more. Wages aren't keeping up, and when factories slow production, layoffs follow. It's a vicious cycle that tightens month by month. Moscow's likely response is the same as always: print more money, raise taxes, and hope it buys time. But that short-term fix only fuels more inflation, forcing the central bank to raise interest rates again. Loans get expensive, small businesses suffer, investment dries up. It's an economic loop Russia knows all too well. Still, the political class continues its performance. State television points to new deals with India, Iran, or Turkey, presenting them as proof that trade is thriving. What it doesn't mention is that most of these agreements are symbolic, nowhere near replacing the massive volumes once tied to China. Beijing was the anchor, and now the ship is drifting. To plug the gap, the Kremlin will likely pour billions into domestic subsidies for its struggling metal industry, essentially paying companies to survive. But in a system weighed down by inefficiency and corruption, much of that money will vanish before it ever reaches workers or factories. Mining towns like Norilsk, Magnitogorsk, and Chelyabinsk, built around smelting and heavy industry, will bear the brunt. As production slows, shops close, schools lose funding, and younger workers move abroad. That brain drain has already begun, and China's withdrawal is only accelerating it. International investors are watching closely too. Even friendly nations like India and Saudi Arabia see the warning signs. If China, arguably Russia's most pragmatic partner, is pulling back, what confidence can anyone else have? In global finance, stability matters more than loyalty, and right now, Russia looks anything but stable. None of this means Russia will vanish from the global stage. It will keep exporting, producing, and surviving, but under growing pressure and at shrinking margins. The decline is slow, not sudden, which makes it even more damaging. Beijing's timing couldn't have been more precise. It waited until Moscow was fully dependent, then scaled back just enough to weaken without destabilizing. That's China's signature move: act quietly, control the outcome, and let the other side realize too late that the balance of power has already shifted. Russia, once proud of its self-reliance, is learning the hard way that even great powers can become clients when they gamble too heavily on a single friend. The question now is, can Moscow adapt before it loses everything it once controlled? Or is this the moment when China quietly takes the lead, not through war, but through patience, planning, and power built one quiet move at a time? One quiet move at a time. One quiet move at a time. One quiet move at a time.